India's diagnostic space is undergoing a transformation. Organized players are slowly taking over the business from local pathological labs, and that's where Dr. Lal PathLabs comes in. One of the oldest brands in India, the company has now drawn up an aggressive growth plan outside its base in North India. Joining us right now to talk about the growth plan and the possible challenges is Prakash Goel. He's the Chief Financial Officer at Dr. Lal PathLabs. Mr. Goel, thanks very much for taking out the time. First off, let's just start off with how the quarter gone by has been. It looked like core Delhi and NCR markets slowed a bit for you.
Yeah, good morning. You're right. This time Q3 the growth is 12.1%. However, the Delhi has grew only 2%, and this is because of harsh winter and December was the coldest this time. So this harsh winter, prolonged winter has impacted this quarter. But the good part is rest of India, which is larger pie, which is 60% of our revenue, is growing much faster, which is 19-20% of growth this quarter.
Okay, let's talk about price increases. Did you take one in the quarter? And did that affect realizations per patient?
So price increase, for quite some time we have not taken any price increase. Last quarter in July last year we took some increase in few tests, but we have done some correction as well. So the growth is coming from the overall volume. If you see, the realization per patient is 688 rupees as compared to 683 last year same quarter. Is slightly higher. The impact of some pricing, but it is impact of mix as well.
Okay. So let's also get in a sense as to what lies ahead with regards to growth coming from SwasthFit. I think this time around it's been growing steadily at about 30% year on year. Is that the run rate for SwasthFit? And also, do you see it contributing more to the revenue going forward from the current 15% revenue share that it has?
So sorry, I'm not able to hear you. Can you repeat your question?
I was asking you about SwasthFit. Do you see it growing at the current rate of 30% year on year that it has been clocking in, and therefore do you see it increasing the contribution to the revenues from the current 15% that it is doing?
Yeah. So SwasthFit is 15% of overall revenue, the contribution from SwasthFit, and it is growing more than 30% quarter on quarter. It's in fact helping us where while one side rest of India where realization is lower as compared to Delhi NCR, why we are able to maintain our realization per patient is because of SwasthFit where the realization is higher, and SwasthFit where we are providing some common test in a bundled package at a discounted rate. For patient it is value for money, for company as well it is making sense for me because I am servicing the same patient and my servicing cost is 2/3. So it's helping me even if I am providing some extra test to the same patient at a discounted rate, it is not costing much or more to me. But while I am servicing the same patient, it makes sense to me, which is twofold where I am maintaining my realization per patient, plus I am retaining the customer as well.
Okay, got that. So this was about Q3. Let's talk about future plans at Dr. Lal PathLabs. What is the key focal area for the management? I believe network expansion is something that you're really focusing on. You want to widen your test menu. You want to diversify geographically to the west and southern parts of India. What kind of steps are you taking to achieve all of this?
It's a good question. In fact, if you see, while our core market north and east is growing, but our disproportionate focus is now on south and west, particularly on west. And we are very aggressive in terms of opening our network through collection centers, opening some of the labs at strategic points. And particularly Maharashtra, if you see, we are growing organically while opening a lot of infrastructure and making our presence there. Another way, if you see, we did some acquisitions. We did 5 acquisitions in last 9 months, and all are in West. And particularly recent 2 acquisition of Sangli and Yavatmal, they are in Maharashtra. So clearly now our focus is on West, particularly on Maharashtra now, and our disproportionate time and focus is going on this.
Okay, so how much of market share growth do you expect in these areas that you're focusing on? And then if you have to compare it to Delhi NCR, which has grown at 2%, when do you expect that to normalize?
See, again, West as a whole is growing much faster than the company average growth. I told rest of India is growing about 20% this quarter, and it is consistently growing in this range, 19-20%. West, our idea or focus is to grow in the same range, which is 19-20%, maybe more. Delhi NCR, I have told you that this has impacted due to harsh winter, and the winter is still continue. That's the reason this time Delhi has impacted much more than what rest of India is.
Okay, so it will come back to its 7-8% growth rate post winters, according to you?
See, it's early to comment on that because we are still facing this winter in north, especially in Delhi NCR. Let's wait for February and end of March. We are able to see how Delhi is, but definitely there is a pressure on Delhi, which is our core market. Having said that, we are doing more focus on rest of India, and that's where we are not totally depending on Delhi NCR. Rest of India is more, which is 60%, 61% of our all revenue, which is growing faster.
Okay, so will the rest of India also be a key contributor to your ability to maintaining your EBITDA margins at 25% plus?
So our normalized EBITDA margin is about 26.8%. This YTD this quarter is 24.4%. While margin in Delhi NCR is higher as compared to rest of India. Directionally, if you see, when the volumes tend to picks up, then the margins are we are getting leverage and optimization of our overheads, and that's where even if you see this Delhi has grew only 2%, we are able to maintain our margins. So optimization and leverage, which is coming from our existing overheads, is where I do believe that going forward also we are able to maintain our margins.
Okay. Mr. Goel, thank you very much for joining us. Appreciate you taking all the time, and all the best for the upcoming quarters. That's the management of Dr. Lal PathLabs talking about shifting their focus now towards the western region, where growth is much higher than Delhi NCR, about 19-20%.
Well, let's see if it helps the stock price or not. That's corrected quite a bit post the numbers. But moving on to other earnings, VATech Wabag reported a muted set of numbers in the third quarter. Strong order backlog did keep the numbers almost flat. Nikki spoke to Rajneesh Chopra, the global head of business development at the company, to find out more about the new orders and execution. Listen in.
If you see year on year for the 9 months, we are almost, where we were last year. But what I would like to highlight here is that if you see in this particular year, every quarter, because of the strong order backlog, we have been kept on improving our execution. And going forward, till March, we gave a guidance of around 3,000 crores. So we are pretty confident that we'll be able to execute 1,000 to 1,200 crores worth of order backlog, and we'll be very closer to the guidance we gave. As far as order book is concerned, we are already at 4,000 crore against a guidance of 5,000 crores. So whatever bids we have already made and where we are well placed, we are pretty confident that we'll be able to achieve our order intake guidance as well.
Sure, I just wanted to clarify, a lot of brokerages have been suggesting that your revenue guidance was 3,200 crore and that has come down marginally to 3,000 crore now. Could you give some clarification on that?
Yeah. See, we gave a guidance of 3,000 to 3,200 crores. So we definitely mentioned 3,000 to 3,200 crores.
So you're going to be meeting your guidance on the lower end this time around.
Right. We'll be very closer to that.
Okay. Talk about your order book, which now...
And as far as working capital is...
Please go ahead, sir.
See, if you look at our financials for the first 3 quarters, one of the major, improvements has come in working capital management. If you see, our debt reduction has been almost 22%, so 275 crores of the debt is something which we have already reduced. So this efficient working capital management and improved collection cycle and advances coming from the new projects, we are pretty sure that our working capital management will further improve and that will aid our execution as well. Even if you see cash flow, the net cash flow has improved and we have generated around 143 crores of cash, in this particular quarter.
All right, sure. Could you just help me with your order book right now? It's at 11,500 crore. What's the composition and what are the key projects which are expected to drive the revenue visibility going forward?
See, if you look at our order book, it's a strong order book of 11,500 crores.
Right.
And as I just mentioned, that in the last quarter, probably what we'll execute will add an equal amount of order book. So when we start the next fiscal year, probably we'll have the strongest ever order book in the history of Wabag. Now, if you look at the total composition, today around 3,364 crores is coming from India and the overseas is around close to 693 crores.
Right.
That's for a particular quarter, which I'm talking about is Q3.
Right.
So up to Q3, we are around 4,000 crores. And if you look at our total order book composition, I think 6,500 crores is what is there in Wabag, India. Apart from that, we have projects under National Mission for Clean Ganga, which has both EPC as well as hybrid annuity, which is around 1,700 crores.
Right.
And Wabag overseas is contributing around 2,516 crores. So total it's around 11,524 crores. The EPC out of this is around 71% and O&M is around 29%. So this is the first time that we have a very good order backlog of our service business, which is operations and maintenance. And one of the key highlights here is that with operations and maintenance, definitely it's not a top line focused business, it's a bottom line focused business. So we expect a margin improvement with the execution of our operation and maintenance order backlog, which is very strong at this point of time.
All right, sir. In that case, if you expect the margins to improve, what is the kind of improvement we can see in Q4 and FY21? If you could leave us with numbers out there.
See, we never give a guidance as far as margins are concerned. So I can only say that you have seen that our margins have been improving.
So right now
we believe
right
that
now
it will
we are
be
looking
better than last year.
Right now, sir, just to put a number to it, right now we're looking at a margin of around 10% in this quarter. For Q4, can we expect a figure which is northward to 10%, or it's going to be a sub 10% kind of a number that we're looking at?
All I can say at this point of time is, since we do not give a forward-looking guidance as far as margins are concerned, I can only say is that our margins going forward will be, only get better than what currently we have.
All right, sir. Last question that I have for you is in terms of debt reduction, what number can we expect going forward?
See, as I said, we'll refrain from giving any forward-looking numbers at this point of time. But then, if you see our recent past, quarter on quarter, we have been reducing our debt, and our endeavor will be to further reduce the debt and improve our working capital. So that's something which we are continuously working on. And also, if you see in our this 9-month results, another factor is, if you see our total cost of operations is something which we have significantly worked on, and we have improved our TCO also, total cost of operations, which has definitely resulted into better margins.
All right, sir, we'll leave it at that. Thank you so much for taking out the time and speaking to BloombergQuint.
It's an optimistic management of VA Tech Wabag and showing in the way the stock is reacting about 3%. But, one more conversation. Microbreweries propping up across the country, a phenomenon that was largely confined to Bengaluru and Delhi for a long time. Newer brewers, including one player from Bhutan, has also made it to the Indian beer market. What does that do for one of the country's oldest and most prominent brands, Kingfisher? And to put the quarter into perspective as well, joining us now is Shekhar Ramamurthy, the MD of United Breweries. Shekhar, so good having you. And I want to start off with that big picture first before we get to the quarter as well. Good morning, Neeraj here. The last time, not the last time really, about a year and a half that we spoke, you had given me this line that no matter what happens to smaller companies, United Breweries will either maintain or better market share because the large will become larger. There is a lot more competition right now. Some has fallen by the wayside, some new entrants have come in. Are you still as sanguine about the prospects?
Morning, Neeraj, and good to be talking to you too. Yes, we are still the market leader. We're again adding shares. But as you rightly said, competition in the space is growing. And competition is not just the big, large international brewers. It's also at the top end, at the smaller level of competitors who are coming in, and brew pubs or microbreweries, as they are called, are mushrooming across the country, and it's no longer just Gurgaon, Bangalore. It's Pune, Hyderabad, Mumbai, and many other cities. Of course, you also have the new entrants coming in this wheat beer category. So all this, the way we see as United Breweries, and I'm sure all the other participants, large participants in the beer space, we see this as helping develop a beer culture in the country. We are, as we have spoken in the past, largely a liquor, spirits, whiskey country. So all these phenomenon rising of the increase in number of brew pubs, new entrants, all help in creating greater buzz and greater activity in the beer space. But we are reasonably confident and about our own prospects. We too have added many brands. We too have launched our own wheat beer called Kingfisher Ultra Wheat Beer. It's currently available in Bangalore, Goa, and it will get launched in other cities as we go along. So yes, we are quietly confident, but we do acknowledge that the competitive space is far more hectic today than it was earlier.
The KF Wheat Beer, Ultra Drought, as well as the export cans, a lot of launches from your end this time. Just wondering, one more question on this whole volumes picture, Shekhar. I see a number of statistics comparing the Indian consumption of liquor at large, not just beer or not just whiskeys, but liquor at large, and how underpenetrated it is. And yet, quarter after quarter or half year after half year, we don't see volumes expanding so much. Was it? If it's an underpenetrated country, why is it that volumes taking so long to expand? And will there be a bit of a J-curve effect that could come into volume growth at some point of time?
Well, you're right. And in our space particularly, we are hampered by the policy framework. As you know, alcohol and especially beer is highly regulated. We are a state subject, so we are subjected to state government taxes and tariffs and restrictions in every state. Prices keep going up, not because we put up prices, but because state governments keep increasing taxes. So year on year is almost a 5 to 10% increase in prices. So that's a big dampener on the category. Price of beer vis-a-vis price of comparable spirit brands is much higher because tax per liter of alcohol and beer tends to be higher than on liquor. Plus the sheer availability. The total number of outlets where you can buy a beer, either buy or consume a beer, is between 75 and 80,000 across the country, as compared to any FMCG, which would be in millions. So that's a big dampener. But having said that, in the long term, there will be growth. It will not be dramatic growth. We will grow along with the country's growth. So the future is interesting, but it will not be exponential growth.
Okay, for the third quarter, Shekhar, volumes declined 7%, but realizations surprisingly strong at about 7%. How does one try and gauge what could happen in maybe quarter 4 or for FY21? Any sense?
Well, all of 1920 has been challenging. Starting off with the fact that the overall economy has seen a slowdown. There are elections in quarter 1 which hamper our business, and for beer, quarter 1 is the largest part of the year. We are hopeful that going forward, there will be an easing in the overall industry in terms of growth coming back slowly. However, having said that, we see overall 2021 growth again being reasonably muted, largely on account of the fact that a large market like Andhra Pradesh has put in place a policy which is very adverse. They have reduced the number of outlets, they have reduced the hours in which outlets can operate. The entire trade has been taken over by the government. Prices have gone up by over 20%. And of course, there is an ordering pattern which does not seem to be basis numbers and rationale. So there is preferential ordering for some of the local players. So Andhra is going to be a big dampener. We've already seen starting October industry having declined over 50% in Andhra, and we don't see that improving. But outside Andhra, we see modest growth in 2021. The comparators vis-a-vis 1920 will be easier. So we will see a little bit of growth in markets outside Andhra.
Okay. So two-part question roll into one. If I look at the next year, would it be safe to assume that at least what you showed in quarter 3, which is the heartening part, which was the margin, the performance, can that be replicated or extended into the next few quarters? And because of the favorable basis, I think, as I read a report which says that how for FY21, both in Q1 and Q4, there was an election impact that came in, and therefore there will be a favorable base there, would probably help your performance, if anything.
Well, in terms of comparators, it would. There's no doubt about that. As you have rightly said, the comparators of this Q4 and Q1 of 2021 will be easier. In addition, we don't see such steep inflation in input costs over the next few months, because this year we've had steep increases in price of bottles and barley. We don't see that happening to that extent. So even the cost pressure would be less. So yes, all things considered, unless, in our business, you can never be very, very sure, unless there are some really adverse policies announced by some key states. 2021, in terms of comparators vis-a-vis 1920, will be easier.
Well, I know the media business is unpredictable. Yours is probably a lot more, Shekhar, so I wouldn't want to trade places with you, but all the best for the quarter ahead and the year ahead as well. Thanks for speaking to us today.
Thank you so much, Neeraj. Thank you.
That's the management of UBL, hopeful, Divina, about at least the margin performance looking up. Everything else remains unpredictable.
Yeah, and so does the market. It's very unpredictable right now. It's at the lowest point of the day for the Nifty, which is just about clinging on to 12,000. Sensex is at 40,899, while the Nifty Bank looks weaker by about 200 odd points. We're done on this edition of Indian Open. Thank you so much for watching from the entire team. A lot more market action continues on the FNO Show.